If you're in financial services and you're noticing that it's getting harder to acquire and retain customers, you need to know about Finimize. Finimize creates the world's most engaging finance content for retail investors, and you can now white label it for your platform. Get access to a library of over 20,000 news, analysis, and education pieces written by former Wall Street analysts with the retail investor in mind. Not only does the access via API or manual download mean simple, fast integration to your platform, but features like advanced tagging let you easily personalize it to your customers' portfolios and preferences. With content available in over 29 languages, it's never been easier to supercharge your brand with content that resonates globally. Find out how Finimize can grow your brand or elevate your content at finimize.com/business.
Hello and welcome to Fintech Insider Insights. I'm Kate Moody, Customer Strategy Director at M-Pesa. In this episode, as we close out an incredible year of news and insights both on this podcast and in the wider industry, I've brought together a crack team of Fintech Insiders to try and make sense of the last 12 months of fintech. If 2023 was a year of turbulence and reckoning for the industry, was 2024 its coming of age? The industry has shown it can adapt, learn and grow, proving its resilience in the face of both opportunity and adversity. It wasn't all solidarity, consolidation and success though. Some stories this year have the potential to shake the industry to its core. Join us as we explore the themes, turning points and lessons that defined fintech in 2024 and what they might mean for the years ahead. To help us untangle them, I'm joined by a fantastic panel of guests. First up, we have my M-Pesa colleague, David-Barton Grimley, Fintech Strategy Director at M-Pesa. Hey David, how you doing? What are you working on?
Hello, I'm good, thank you. I've always wanted to be a part of a crack team. So this is great. I'm now in this team. I've actually just gotten back from Barcelona, which is very, very cool, working with some lovely people there who may or may not be listening to this podcast when it comes out. And my fun fact about that is after the meeting, I went to get as much sun as humanly possible before jumping on a plane back to London. I literally just sat there and just absorbed vitamin D and then got on a plane.
Nice.
So yeah, that's
Is this you at peak tan? Should I
peak tan? Peak winter tan.
Peak winter tan. Well done. Congratulations.
Thank you.
Next up, we have another 11 joining the panel. Benjamin Ensor, Director of Research and Strategy at M-Pesa. Benjamin, we hang out quite a lot, but nice to hang out with you on the podcast. What have you been working on? Have you been anywhere sunny?
I've not been anywhere sunny recently, unfortunately. We did just publish a report on how to take open banking payments mainstream in the UK with Go Cardless, just ahead of the UK's national payments vision. So that's gone down quite well. So that was fun. And then I've been working on a project in capital markets, really complex sort of digital transformation, looking at sort of service design across a whole range of different types of users, moving stupidly large amounts of dollars or euros or whatever. So that's quite fun. But I haven't been traveling anywhere recently, which is a shame.
I'm sure the new year will see that change. And finally, completing our lineup is Jason Mikula, founder of Fintech Business Weekly and head of industry at Taktile. Jason, always an honour and a privilege to have you on the show. Thank you for taking the time to join us. Especially you're launching a book, right? You must be really busy. How's that going?
It is going well. Actually, I believe that as we're recording this, I think it's already available in the UK, and around the time this publishes, it should be available in the US and in the rest of the world. So it has been busy, but rewarding as always.
Is that like all of the gifts for your family and friends sorted for Christmas? Are you all getting the book under the tree this Christmas?
They're going to be asking for coal in their stocking instead of the book, probably.
Well, yeah, hope it goes well. Brilliant. Well, we have a panel, so let's dive in. To kick off the show, I think it's worth reflecting on how just 1 year after the American banking crisis of 2023, the fintech industry has not only demonstrated remarkable resilience, but emerged stronger than ever. To start with, I think we should start by looking at a key macro trend for financial services in 2024, and that's consolidation. So consolidation in 2024 was evident in the amount of high-profile mergers and acquisitions that continued where 2023 left off. By September, there had been 83 bank deals announced in the US alone, with 35 domestic bank consolidations in the UK and Europe in the past 12 months. quite a few deals, but some notable ones that took place were back in October. Nationwide completed its acquisition of Virgin Money for £2.9 billion, well under its value. Then in November this year, also in the UK, Barclays completed its acquisition of Tesco Bank, absorbing its retail banking services and millions of customers. So the acquired business includes credit cards, unsecured personal loans, deposits, and the operating infrastructure, which, following completion of the acquisition, will continue to be operated under the ownership and management of Barclays UK. Whilst across the pond, Capital One and Discover announced a merger that's now under heavy antitrust scrutiny. The deal will create the largest US card issuer with around $250 billion in card balances and a market share of 22%, according to TD Cowen. For listeners outside the US, Discover and Capital One focus on customers that don't need or want a premium credit card offering like Amex. Plenty of other M&As and consolidations we could point to as well. Benjamin, what do you think the trend of mergers and acquisitions we've seen over the past year means for the future of FS?
I think this is just sort of, Schumpeter's creative destruction. I mean, it's a natural process in capitalism that organizations evolve. And over time, some of those organizations are no longer needed. If you think about the history of the banking industry, banks emerged geographically, right? That's why so many of them have geographic names. Take Virgin Money. That part of that was originally Clydesdale Bank and Yorkshire Bank, little parts of the UK. I mean, they're quite big, but in global terms, quite small. The same a lot of these other ones. And so really this is about economics of scale, or economies of scale. You need to have a big factory and you need a lot of stuff going through your factory. Running a bank costs quite a bit of money. There's lots of things you have to do for very good reason, compliance, anti-money laundering, and so on. And all of that takes time and money. So the more volume you have going through that, the better. And some of these organizations have kind of lost their way. Personally, I never really understood the point of Virgin Money as a brand. Some people love Richard Branson. He's an amazing entrepreneur. He set up an airline. He set up a Coca-Cola business. He set up a cola business. He set up a train company. He set up all sorts of things. But at some point, when a brand is slapped on everything, it's like, well, what does that actually mean in banking? So I think some of the firms that have been acquired are firms that didn't have scale and didn't have a differentiated customer proposition anymore. And what we're seeing is younger customers, more digitally minded customers, are going to a whole bunch of fintechs. And what we're seeing is some of the older firms that didn't have a really clear raison d'etre are struggling and giving up.
I wonder whether supermarket banks are an interesting kind of sub-segment of that. So, in the UK, I certainly remember like 15, 20 years ago, supermarket banks were absolutely a massive thing. And I think it would have been the case that supermarkets were just this massive distribution channel, I suppose, the idea that they have loyalty programs and we can cross-sell financial services and all of this kind of stuff. But if you fast forward to now, they just seem, maybe I'm being overly negative, but they just seem maybe a little irrelevant in some ways. I feel that the digital revolution and fintechs may have overcome them in some ways. So there's a few examples of M&S Bank going to HSBC in 2021. Sainsbury's have agreed to sell their retail banking division to NatWest.
It's really hard for a senior management team to focus on doing multiple things well simultaneously, right? So if your primary business is retail or groceries, or you're a post office or whatever, it's really hard to simultaneously build a really strong bank. Now, throw in legacy systems, and suddenly, it's something that seemed like a really good idea in 1990 or 2000 or 2010 no longer resonates with customers, and you haven't got the management energy, the systems, the drive to really innovate, particularly if you've got issues going on in your core business. You just gave a bunch of UK supermarkets. Well, they are under attack, I suppose, by new entrants from Germany like Aldi and Lidl. So their core business is under threat. So guess what management's focusing on? The core business.
Yeah, no, it makes sense. In some ways, it just seems such a shame to me, though, from like a customer perspective, that we haven't managed to see them come through this period, that they are seemingly just sort of giving up, because we know from like a customer perspective that the outlay on your petrol, on your groceries, on these things that you can't just stop doing is kind of one of the biggest levers that especially sort of financially constrained people have to kind of try and change whether they make it to the end of the month with something left in their account or not. Like actually kind of, yes, you could choose to cut out one subscription and that might make you feel like temporarily better off, but actually if you can find efficiencies in the amount of outlay you have on feeding your family or traveling to your place of work, like that's kind of where actually you feel there should have been an opportunity for like a blend between supermarkets and banking to kind of find an innovative solutions for customers to make their money go further. But we just haven't seen that happen, I think, for the reasons that you've outlined, Benjamin.
In the UK. But, there's examples in other countries, President's Choice Financial in Canada and so on. There are plenty of other supermarket-related banks that are also doing trust
in
banking.
Singapore. Yeah,
Exactly.
absolutely.
Yeah, absolutely. Jason, let's bring you in. What's been your take on this trend this year?
Yeah, I mean, certainly in the U.S. market, there's been a long-term trend towards consolidation, primarily through M&A, right? So if you look at, the 20, 30, 40-year timeline, the number of chartered institutions has declined and seems likely to continue to decline. And that's notwithstanding variations both in market dynamics as well as sort of like the regulatory or public policy attitude towards consolidation in the banking sector. I think a couple of interesting things to note that we've seen over the course of the last 4 or so years during the Biden administration. You've had minimal de novo activity, meaning minimal new banks being chartered. At the same time, you've had heightened scrutiny of bank M&A. So you've seen less merger and acquisition activity, primarily driven out of a reluctance to see already large institutions get even larger, as well as some resistance to the idea of so-called charter strip acquisitions, meaning fintechs that want to become banks rather than applying for a net new charter, becoming a bank through an acquisition. So we have seen that in the past, right? Lending Club acquired Radius, Column acquired not Golden Pacific, acquired I want to say it was called like Chico State Bank in California. SoFi acquired Golden Pacific. But there's also been some resistance to that model as well. These things seem somewhat likely to reverse in a incoming Trump administration, although there is a bit of a wild card there in the sense that apart from Treasury Secretary, I'm not aware of any major regulatory announcements for the incoming administration. And there's ample reason to believe that some of the policy choices and thus some of the personnel choices may look a bit different from Trump's first administration. So I think like the broad consensus is towards lighter touch regulation. Whether or not that extends to banking M&A remains to be seen, with perhaps the biggest wild card being what is the future of the proposed acquisition of Discover by Capital One, right? So blockbuster deal that was announced, I want to say earlier this year, if I'm not mistaken, which a lot of folks were kind of skeptical would come to pass if Democrats remained in control. The prospect for that deal actually coming to completion under a Trump administration seems somewhat more likely, but there are a lot of open questions there that remain.
Yeah, I guess to stay on the topic of the US and sort of antitrust kind of focus in the US, Benjamin, obviously we had the announcement, I think in March this year, of Visa and MasterCard agreeing to kind of limit credit and debit card fees for merchants. Have we seen kind of the impact of that play out this year, or is that something that you think we're going to see stretch more into 2025?
I think this will run and run. I mean, if we take the American banking industry, or indeed the German banking industry, the Italian banking industry, there are far too many banks, or there were historically, and that's driving that consolidation. In terms of credit card networks, to some extent, Visa and MasterCard are the only sort of global games in town. Obviously, there are other networks like Discover, like American Express, and then there's a couple of other networks in Asia. But there's this deep resentment among merchant industries, so in retail and other sectors, at the fees that they pay on cards. It's a very profitable business, and you could say, is it profitable because you essentially have two big players, and is that a case where actually, the antitrust settlements didn't come through fast enough? I mean, all credit to Visa and MasterCard. They built fantastic companies. They've got amazing products, but those products are expensive for retailers, and because the costs of those interchange fees are effectively hidden from consumers. In effect, it's kind of a hidden tax. And so you're always going to have this sort of resentment from retailers. You're always going to have, and it varies from country to country depending on the regulations and so on, but you're always going to have retailers looking for, can we bring our costs down? A lot of retailers operate on very narrow margins. So getting your debit card or your credit card interchange fees down can make a big, big difference. It's not surprising that that settlement was in the US because the US has had higher fees for a long time, because we've seen regulators in the European Union, in Australia, and various other markets limiting fees. And we haven't seen that in the States, which is why it's ended up with that kind of antitrust route.
Yeah, no, absolutely. Definitely one to watch. Another high impact moment of 2024 that we probably need to talk about is the current state of banking as a service, particularly in the wake of the collapse of US provider signups. This has had far reaching consequences for millions of people and might even shake the very nature of the industry to its core. Jason, I guess anyone who's been following you on social media will see that you've been putting a lot of diligence and thought into kind of covering this story as it unfolds in multiple stages. So would you mind giving our listeners who maybe haven't been staying as close to it as you have a bit of an overview of what's happened and why it's such a significant event?
Yeah, absolutely. Just very briefly on the Visa MasterCard settlement, if you're referring to the class action settlement with merchants, that was actually rejected, set aside by the judge in that matter. So as best I'm aware, that negotiation remains open. So a lot of sort of uncertainty around how that plays out, as well as a couple of other factors that could impact both credit and debit interchange, like the Credit Card Competition Act, as well as the Federal Reserve's rulemaking that would lower the cap on Durbin-covered debit transactions. So a lot of moving parts there that I expect will continue to develop next year. Regarding banking as a service, yeah, I mean, it has truly been a wild ride in 2024. Synapse, certainly the story that has remained in the headlines. I mean, even the day prior to recording this, there was a hearing in that bankruptcy case that saw the Chapter 11 trustee, former FDIC chair Yelena McWilliams, tell a really harrowing anecdote about her father in communist era Yugoslavia, and actually be moved to tears in the course of this bankruptcy hearing. So I mean, that matter is still going. The very high level summary is basically, Synapse was not profitable, fell into bankruptcy in April of this year, was unable to reach a deal to be acquired by another company in the space. And as that bankruptcy process went on, actually there's this realization that the books and records, the ledgers that Synapse had, were inaccurate, did not match the amount of funds that the banks involved actually held. And the upshot of that has been, many users waited months to get money back. And then, in fact, at the beginning of November, a large number of users realized they would be getting either pennies on the dollar or, in fact, nothing at all back, which, is not how banking is supposed to work. I think it is casting a number of questions on what, if any, regulatory response is appropriate here. So we've seen some activity specifically from the FDIC as far as rulemaking that they argue would address this situation. And, also questions about the viability of the middleware model from like an economic perspective. So a lot of flux and a lot of uncertainty as we sort of move into 2025.
The interesting thing to me is, to some extent, this seems like a little bit of a self-inflicted wound by the American regulators collectively, because it's so difficult to get a banking license in America, because it's so costly. It's such a slow process. It's such a difficult process. There are so few licenses available, unlike, let's say, I don't know, Hong Kong or Singapore, or, pick any other country almost. That's driven American fintechs to say, hey, why don't we partner with sort of banking as a service providers? Why don't we take advantage of the Durbin Amendment, which of course, as you say, gives that slightly better interchange fee. And so that sort of encouraged the growth of companies like Synapse. Now, I suppose the big question is Synapse just a bad apple in a barrel? Was that just a uniquely incompetent sort of set of people? Or to your point, Jason, is the business model itself fundamentally flawed? But I do wonder if the American regulators have made it just a little bit easier to get a banking license, whether more fintechs would have gone down the banking license, the charter route, and not ended up sort of doing these partnerships with these relatively small firms.
I do tend to agree with you that the difficulty in obtaining a classic bank charter, as well as the absence of any sort of alternate category, right? So in the UK, you have e-money institution, payments institution. There was an effort actually dating to late in the Obama administration under Obama's comptroller of the currency, Thomas Curry, to introduce some kind of, quote unquote, novel charter. Brian Brooks, the acting comptroller at the end of Trump's administration, did sort of try to progress that quite aggressively, actually. But there's been, quite a bit of pushback from multiple corners, right? Both from state licensed institutions, right? So state licensed banks dislike this idea of a federal non-depository charter, as well as pushback, perhaps unsurprisingly, from established banks, right? If you're whether you're a Chase or a small town community bank, the idea of having some kind of non-depository charter, ultimately undermines the economic advantage you have that is protected by that regulatory moat. And so, when you have 4,500 banks plus another 4,500 credit unions that have an immense privilege that goes along with holding that charter, you have a huge industry and a huge incumbency that has a motivation to push back on any change in regulation that will undermine the benefits and particularly, the economic framework that goes along with holding that charter.
Yeah, and I think that's a really fair observation. David, do you see this as a sort of specific issue in the US banking as a service space, or is it rippling out into other markets as well?
I think yes and no. I mean, the way that the market in the EU and the UK is assembled is a little bit different. But yes, I mean, if you just look at Railsa, for example, and you look at some of the recent troubles that Solaris is facing into, there are kind of similar systemic business model issues that come up. But one of the things I think is kind of interesting is it might just be a symptom of the fact that when BAS was, founded as a thing, there was this idea that you could have these, let's call them technical banks, right? And there would be this huge proliferation of fintech and everybody would be making neobanks, and these neobanks needed to be powered by these types of providers, et cetera, et cetera. But now what you see moving into the future is more of an embedded finance view where you have more specific use cases where data is much richer on the customer and on the business, and therefore certainty in some areas could be more proven. And therefore the banks or the fintechs that have the licenses are definitely looking a lot more forensically at the quality of the customer, the quality of the data, and at the underlying profitability of lending into the fintech or providing savings accounts or whatnot. So I suppose I'm rambling a little bit, but what I mean is that the net result of this business model being challenged is the people who are founding businesses now and looking into this are much, much, much tighter around credit controls and KYC checks and all of this kind of stuff. But also they're looking at areas which are much more fundamentally profitable. Now, what that does mean in some cases is limiting the areas where BAS can be effective. So one of the things that I hear a lot is that if you really want to be profitable in this area, you have to have scale. You have to have phenomenal scale in order for this to work. And, particularly if you're thinking about things like revenue sharing between a license holder, a middleware BAS, and the embedded finance brand that offers it. You've got multiple parties, multiple fingers in the pie. So you do need a hell of a lot of scale to make that work. But there are some businesses that I think are very interesting to kind of watch. So in the EU, for example, you have Swan, who is doing really, really well. In the UK, you've got NatWest Boxed, which is a very interesting business in their partnership with Vidino in the EU. And I think it's also very interesting to reflect on NatWest for a second, right? Because they are, they're a bank, right? They're one of the largest banks in the UK. they have the balance sheet, they have the controls to be able to provide these services in a way that is going to be compliant to them and limit the risk. So I think it's still very much in flux, but there are some positive signals, I think.
Yeah. I suppose, Jason, just to bring it back to Synapse to kind of close out this chunk, I mean, is there light at the end of the tunnel? I appreciate it's a constantly changing picture, but as you alluded to in your initial intro, like some of the personal individual level stories here are really distressing, like people losing life savings potentially at quite significant scale. So yeah, what's your perspective on how you think this is like to shift?
I mean, with the Synapse story specifically, it's not looking promising, in the sense that the bankruptcy as a legal process is really not designed to address the situation that exists, right? I mean, there is, and forgive me for my ignorance of how this works in the UK, there's a reason why the US does not let banks go bankrupt. I mean, literally, like that is not the process, even for something like SVB, which happened in 2023. A bank does not go through the standard bankruptcy process that any other, non-bank company would go through. And as we've seen in the Synapse case, the power that the trustee has, which for those that are not familiar in the bankruptcy process, the Chapter 11 trustee basically takes over and replaces management of the company or management of the estate on behalf of the executives who at that point step out and no longer involved, as well as the judge in the case. They're limited in what they can do. They can't order the banks involved to hand over money to the end users, to the depositors. And so what is already beginning to unfold is another wave of civil litigation where you see impacted end users. So the customers of these fintechs like Yada, like Juno, file civil lawsuits against basically everyone involved, but certainly the four main banks. And you're also seeing litigation from some of the fintech programs. So, for example, Yada has filed suit against one of the main banks involved in this Evolve Bank and Trust. And, the unfortunate reality is that when lawyers are involved, things tend to move fairly slowly. And particularly in class actions, a significant amount of any recovery often goes to the lawyers who are executing the cases. And so I'm certainly hopeful that civil litigation or perhaps some other regulatory process or hearing or investigation provides additional light on what has happened here. I find it utterly unacceptable if this situation sort of comes to a conclusion without a clear answer as to how much money was missing, which we still don't know, at least the public doesn't know, I don't know, and what was the cause of that shortfall and who's responsible. So for, unfortunately, end users who have not already received their money back, are likely to be waiting for some time. And there really is no guarantee that they will get those funds back.
Yeah, no, it's really, really difficult. And as you say, one that's going to take a while to resolve. So we'll have to keep watching to see where this ends up. Okay, we're going to take a quick pause, but don't go anywhere. As the second half of the show, we'll be looking at some incredible industry success stories that we've covered over the past year. It's all coming up after this quick break.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing Trust Center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Quora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.
Welcome back to Fintech Insider Insights, where we're looking at the stories that shaped our industry over the last 12 months. In 2024, we've seen a wave of neobanks across the globe, including Monzo, Starling, Revolut, N26, Nubank, and Dave, all post sizable profits, and Revolut finally got its UK banking license. So Monzo achieved its first ever full year profit of £15.15 million. Starling Bank's profits surged 55% year over year to £301 million. Revolut achieved £438 million in pre-tax profit alongside £1.8 billion in revenues. N26 has also reported its first ever quarterly pre-tax profit. Nubank hit 100 million customers in just Brazil alone, and it is also profitable. UAE neobank Wio hit profitability after just 1 year of trading. Singapore neobank Fingula making a profit after just 9 months of trading. And US neobank Dave achieved its first quarterly profit in 2024, 8 years after it launched. Whew. That's a nice positive list. DBG, what changes? We talked about business models earlier. Is this just, business models paying off? Have we seen changes? What is driving this kind of wave of profitability?
Yeah, I mean, a lot of it is revenue per customer, right? And quite frankly, what do banks do to make money? They lend. And these banks are lending, and they're lending very efficiently. They've got the right kind of credit models. They've got, the right kind of architecture underlying that does it. So, for example, I'm a Starling customer, and Starling are making something like £69 per customer per annum, which is great. And, one of the reasons why is they were very early to launch overdrafts, and they were one of the earliest fintechs in the UK to launch an overdraft feature. And because I very rarely use Starling, I'm constantly going into my overdraft whenever I do, and they charge me for it. So, they're making money. They are making far more money, in fact, than some of the other fintech providers out there. But it's just personally, as a consultant, it's just such a relief to see that the things that we have been saying, me and us at 11FS and everybody, that hey, listen, neobanks at some point are going to be profitable, and it's just nice to see that we could say to all of our clients they actually are. All over the world, there is a model for a challenger bank to be really rather profitable.
A lot of it is scale, right?
Yeah.
So you're absolutely right about the lending, and obviously as you scale up lending, that really helps. But a big part of it is scale. As you go from 10,000 customers to 100,000 customers to 1 million customers to 10 million customers, or up to 100 million customers, your employee costs and all of your other costs don't scale in anything like the same way as your customers, right? So what you see gradually, if you look at these businesses over time, and what Wio achieved so quickly is tremendously impressive. But if you look at them over time, you can see that their costs per customer gradually or steadily fall. Meanwhile, their income per customer goes up and up, particularly if you're doing what Revolut is doing of constantly rolling out new products. I mean, one of the things that Revolut and Nubank and so on are so impressive at is they're constantly adding new features, new products, new ways to generate revenue, new ways of finding that, David is too foolish to check his bank account often.
I need to shut that down.
And so that really just drives the economics, right? It just, as you pump more volume through those factories. So what's happening, is all of these digital banks all around the world, as they're winning this new generation of customers, as they're getting that scale, their economics are improving. And of course, what's also happening is some of the established banks are losing those customers, people in their 20s, people in their 30s who might have become a customer of an established bank today haven't. And, we are also seeing, people moving more of them, because people used to say, hey, this is just a secondary account. Well, yeah, for some. But actually, there are people, I think instead of shutting your Starling bank account, maybe you should think about shutting your other bank account. Anyway, we're not going to get into financial advice.
Jason, which of that list have you been most impressed by? Or it could be outside that list. Maybe there's something we've missed, right? Who's caught your eye?
Well, no, I mean, as I was preparing for the show today, something that struck me is if you asked me 4 years ago, 2020, what geography would I think would have profitable neobanks first, I would have said the US before the UK or the EU, primarily because of the interchange, which we've already touched on a little bit earlier in the show. And one component that ticks and ties with the lending is rising interest rates, right? So Monzo, Starling, Revolut, here in the Netherlands, Bank, have been beneficiaries of higher interest rates. I mean, even in continental Europe, where use of consumer credit is significantly lower, in 2020, the ECB rate was, I believe, negative 25 bips, right? So if you were Bank, which is a fully chartered Dutch bank, but you were parking those funds, customer deposits, primarily at the ECB, you were actually paying 0.25% to do that, right? It was a drag on earnings, not, it was not a revenue generator. And, as we went through COVID and then inflation and then higher rates, not so nice for people who saw their mortgage reset, but for banks who, as we've touched on, their primary business is holding deposits, making loans. As rates go up, typically net interest margin, which is the delta between the amount they charge on loans versus the amount they pay on deposits, typically increases. And so neobanks that have a reasonably well-developed, mature lending business with the elements that we've touched on, sophisticated credit risk underwriting, servicing, collections, customer acquisition, distribution, not that they can control the interest rate environment, but they have benefited from rates increasing from what were, essentially historic lows of 0 or less than 0. I do think that Nubank and other developing economies provide a very interesting lens into what the future of neobanking or digital-only banking could look like in developed Western economies, in the sense that a lot of their customers tend to be net new entrants to the banking system, as opposed to customers that Nubank, or other markets, Mexico, Africa, et cetera, tend to be net new entrants into the banking system, and not necessarily customers that were sort of won from incumbents. And that as we go through generational change in Western Europe, in the US, you may see that shift to some extent anyway from bricks and mortar incumbent distribution to more digitally native players, whether that's the Monzo, Starling, Revolut in the UK, whether it's players like Bank here in the Netherlands, or in the US, your Chime, Vero, Current, Cash App type players.
Yeah, no, absolutely. Benjamin, obviously in the first half of the show, we talked about consolidation of incumbents, consolidating. Now we're talking about established fintechs reaching scale, reaching profitability. Do we think this is kind of solidifying what the market is going to look like for the kind of foreseeable future? Is it just going to be incumbents versus scale fintechs, or are we going to still see new entrants coming in and trying to disrupt?
I think in a way that's the wrong way to view it. What's happening here is there's a generation of businesses that have embraced digital technology. And by embracing digital technology, they've been able to radically reduce their cost in some areas. Nubank, as Jason was just talking about, is a really good example of that. If you look at Nubank's cost-income ratio, it's really, really low. It's much, much lower than that of most of the sort of established traditional banks. But at the same time, you have got, large established banks around the world, take, DBS or Commonwealth Bank or Westpac in Australia, or, pick, BBVA or whatever, really embracing digital technologies and trying to bring their own cost-income ratios down in the same way, right? So we've got many established banks really embracing digital technologies and trying to get those same kind of efficiencies. What's falling away is the firms that ignored digital, the firms that thought, this doesn't matter, the firms that were dismissive of fintechs, the firms that were dismissive of digital technology, the firms that invested too late, because what they're finding is they've still got those same costs because they haven't done anything or they haven't done enough about it. And yet their profits are gradually falling away because they're losing customers to new propositions. the industry will never stop changing it. If you look at the history of stock markets, right, it's very, very rare for a big company to be successful for more than 50 years. It's an incredible achievement for companies to be successful. So companies like Coca-Cola that have been around for 100 years plus, incredibly impressive, because actually you get this steady rotation. Now, banks have to exist, right? Economies have to function, but that doesn't mean individual banks have to be successful. So I think there's another wave coming. We just don't know what that is yet. It's probably AI, but there's another whole wave of disruption coming. We just can't see it yet.
One maybe worry bead or sort of counter flow to this might be fraud. So, we've spoken so much on this podcast in 2024 about fraud and how it's just growing almost exponentially, actually. And the fintech challenger banks, are really front and center of that, right? Like Revolut in particular comes under constant criticism for, all of the sort of fraud that goes through that, mule accounts, all of that kind of stuff. So it'll be an interesting thing for 2025 to see how the regulators begin to crack down and the extent to which the challenger banks can actually bring in some of those more mature fraud controls that some of the established banks actually have.
And it's a really great point, because actually if you think about some of the difficulties that some of these firms have had, I mean, obviously Synapse, as you were talking about, sort of clearly didn't have a lot of controls at all. But many of these other firms, like Solaris got in trouble for anti-money laundering. Yeah. A number of firms, including established banks also, have struggled with that. And you're right, the Revolut and also Cash App in the States, there are certain fintech brands that are a little bit too closely associated with or too often seem to be becoming vectors for fraud.
Yeah, no, fraud is definitely one that we need to continue watching out for in 2025. Another thing that we need to keep our eyes out for in 2025 is IPOs, everyone's favourite thing to ruminate around. So we had confirmation this year in 2024 that Klarna, the Swedish buy now pay later giant, has confirmed that they had confidentially submitted an application to the US Securities and Exchange Commission related to the proposed initial public offering, or IPO, of its ordinary shares. Jason, is 2025 going to be the year of the IPO? Who are you excited about?
It certainly seems like that is entirely possible, right? And these things are always cyclical, right? I mean, the phrase of the IPO window being open or being closed. There certainly is a backlog of companies that are, reaching a level of maturity and reaching a level of, hopefully, profitability to facilitate going public. And I certainly think there is, demand for that, both from, VCs and by extension their LPs who are looking for liquidity, as well as from public market investors who, want the opportunity to invest in what are hopefully well-priced, high-growth companies. Something that I think continues to sort of shape the VC ecosystem, and then by extension, fintech, our sort of world, our discipline, is the companies are staying private for longer. And there's all sorts of reasons why that's the case. But it does sort of allow more of the upside or potential upside to be captured by private market investors versus public market investors. And so it does seem like the stars may be aligning. I guess I should knock on something for the IPO window to open a bit in 2025. I don't expect it to look like the SPAC craze of COVID, where you had all sorts of dubious companies with very questionable business models or financials splashing out onto the public markets through that mechanism. But I certainly think, again, later stage, either profitable or a clear path to profitability, names that everyone listening to this would know: a Stripe, a Klarna, a Revolut, a Chime. So we'll see, but it's looking reasonably promising.
Yeah. And David, obviously Klarna have implied that they won't be IPOing in London, that they're looking at New York instead. Are we going to kind of see 2025 maybe as being kind of a year when these different fintech hubs, Frankfurt, New York, London, have to really try and work out kind of how they become more attractive to attract these potential IPOs?
Yeah, it's such an important question, and unfortunately, the UK just seems to be losing out. I mean, I think the founder of Revolut said that listing in the UK would be not rational, which is it's sort of all over the news at the moment. And it just seems that the US is just a much better place to list. I guess it just has much more volume, much more liquidity, potentially for a higher valuation on listing. I don't know. I'm sure there's many reasons behind it, but the UK is absolutely losing out on that one.
Benjamin, what do you think needs to change?
I think for London, it may be too late. I mean, people obviously didn't vote for Brexit to boost the City of London, but that certainly didn't help. But, there was a time 30, 40, 50 years ago where London, partly because of its geographic position and English language and so on, was very well positioned to be the financial hub for Europe and elsewhere. Leaving the European Union was very unhelpful. The American capital markets are just so much deeper. They're so much more liquid. There's access to so many more investors. It's, we've seen stock exchanges in many other countries sort of fall away. Unfortunately, I think it's probably too late for London to really turn it around. I think it's more just a question, you potentially slow that down. But, unless an American government does something really, really weird that kills the American capital markets, and why would they? It's very hard to see London getting back to the sort of preeminence it had 30, 40, 50 years ago.
Let's just hope for London's perspective that Trump comes in and does something mad and saves us from ourselves, our own incompetence. Okay, this brings us towards the end of our show, sadly. Usually at the end of every episode of Fintech Insider News, we like to end on our And Finally section where we cover a more lighthearted news story from the world of financial services. To round off this show today, however, I'd like to ask our panel to tell us about one story or trend that's caught their attention this year that maybe we haven't covered in the show so far. So, Benjamin, what's your favourite story or trend that you've been keeping an eye on this year?
It's embarrassingly obvious, but it's very, very hard to avoid AI. And I think there's two main reasons why AI is so fundamental to the future of not just financial services industry, but all industries. The first one, to the point David was making, is the way it powers fraud. It is really scary, the extent to which AI can now just fool people, that people are getting increasingly fooled by all sorts of deep fakes. And the power of that technology in the hands of criminals who are working internationally, when law enforcement is mostly national, is very, very frightening. The second thing that is both exciting and frightening is the potential for AI to fundamentally change the way that humans create value. AI has enormous potential to augment what all of us do, but it also has the potential to replace what all of us do. So I think for everyone listening to this podcast, for all of us, we've really got to think about, how is AI going to change the way that I create value as an individual? How do I use AI to create more value? And how do I avoid finding that the things I'm good at, like spelling or whatever, are just better done by machines than me? So how do I find a way of creating value? And I think that's enormously scary for people all around the world.
For sure. David, what about you?
Yeah, annoyingly, I'm going to say the same thing.
Oh, no.
But the spin, well, I'll also talk about something else as well. But the spin on that is less about, where is AI going to create customer-facing FS experiences, which I don't think it will at any time soon. I think that would almost be crazy. But it is just extraordinary, the productivity gains that you have just in work. Me personally, I mean, I use, whether it's ChatGPT or Copilots or Gemini or whatever it is, for pretty much everything that I do. And most everybody that I know does it for pretty much everything that they do. And it has become so ubiquitous and will continue to be so for such a long time. But to addressing your dismay, Kate, the other thing that I am also interested in is digital identity. So we did a very interesting podcast recently with a really fantastic panel talking about what digital identities can solve for, and also, quite frankly, what they won't and what they can't. And the differences between, a centralized identity and something that is a little bit more self-sovereign, which I know is something that Chris Skinner is very, very into and very, very interesting. And I think what I took out of that conversation is that digital identities are very hot now. with governments. It's a controversial topic in the UK, for example, politically. But with the backdrop of fraud and the complex needs that we have, it isn't a balm for everything by any means. So it'll be interesting to see what happens there in the next year.
Jason, I mean, you are also allowed to say AI if you want to, but I mean, I do play sort of like an informal sort of non-alcoholic drinking game now on the show and in meetings with banks, where every time someone uses the phrase AI, I sort of metaphorically down my drink. So, yeah.
I will not say AI. We don't want you to get tipsy on non-alcoholic beverages. No, but this may be a reflection of, where I've been spending my time and brain power in the course of the last couple of weeks or months. But a trend that I find actually a bit concerning is the increasingly extreme politicization of sort of like banking and bank regulation. Obviously, government has always had a strong role in sort of determining the rules of the game, so to speak, and thus by extension, there's always been some political or some partisan element to sort of determining what those rules would be. I do think that that has been slowly changing for a long time, particularly in the United States. And I do think that, we may be entering a bit of a new era where, for example, the amount of money that flowed, particularly from crypto into the US elections, was just absolutely astounding. I mean, I want to say it was north of $130 million that crypto industry at large spent on supporting specific candidates. And you've also seen quite strong partisan alignments coming out of tech or coming out of Silicon Valley in a way where you really haven't seen in the past. It's difficult to say like exactly how that'll play out. But I do think it has the risk of causing, what was already a pendulum that would swing sort of back and forth, administration to administration. It does risk sort of escalating or aggravating that further. And while, the sort of team in power at any given time may benefit from that, I think over the longer term, it risks continuing to erode the credibility of institutions and the trust in institutions, including in banks, right? I mean, to sort of link this back to one of our earlier stories, what is the impact of synapse and of people sort of feeling like they lost money that they felt they were putting in a bank? Sure, it was only, tens of thousands of people and it was only, $80 or $100 million. But if you start to think about that, multiplied out, whether it's in crypto, whether it's in other areas, lack of protection from fraud and scams driven by AI, it does risk continuing to undermine consumers' faith in, not only in government, but in banking and financial institutions writ large. And that, I think is something that we all have a stake in and should be concerned about.
Yeah, no, absolutely. Or hugely important topics. I suppose very selfishly, the thing that I've enjoyed kind of watching play out, which I don't think is necessarily quite the same scale, is I'm really interested to see us reach the stage in this industry now where we do have almost like a catalogue of different routes to success for fintechs. And as we sort of have lots of early stage founders on the show, or kind of that we get to speak to as part of our day-to-day roles, I think you're increasingly seeing either people kind of like really looking to establish routes to success and trying to learn from that and evolve their business models and how they're scaling their businesses to kind of learn from fintech success, or you're seeing kind of founder teams that have already been in a Revolut or a Chime or something like that, who are sort of starting anew and starting afresh and trying to build in all of these learnings around how you might deploy AI differently, how you might design differently for sort of data protections and fraud. So I think we're in a really interesting moment in the industry now where we've kind of got this wave of fintechs that have become successful that are now laying the foundations for new founders to kind of think about how they might set their businesses up slightly differently to kind of, as Benjamin says, like continue iterating and shaping the industry as we move into 2025. So lots of kind of big, important stories. And I think also people that are really like learning from the industry and trying to use that to shape what they do differently going ahead. But yeah, absolutely impossible for us to do justice to the entirety of the year in fintech in just one show. But I think you guys have had a pretty good shot at doing it. So thank you so much for joining us. Where can people find out more about you, Jason?
They can subscribe to the newsletter at fintechbusinessweekly.com, and they can learn more about Taktile at taktile.com.
Awesome. David?
And me on LinkedIn, David BG.
Is it David BG on LinkedIn, or do you have to put in the full Barton Grimley?
No, I think it's just David BG, unless I've been saying it all this time and it just directs you to someone whose surname is just BG. It's possible.
Could be possible. Okay. I'll go stalk you after this to find out. And Benjamin, what about you?
I'm always frankly bemused by the idea that anyone would want to find out more about me, but Benjamin Ensor on LinkedIn.
You do have interesting revelations about, like your use of cassette tapes and things like that. So,
cassette tapes.
That is a lie.
We've got it on recording from one of the past shows. You talked about using cassettes or something. I swear you did. I'll have to dig it out from the archives.
Love that.
And you can find me also on LinkedIn. Also, I suppose similar to Benjamin, I don't really have huge amounts of interesting to say. But if you want to send me any fintech baby swag, then feel free to. I was about to head off on maternity leave. So thank you very much for listening. If you like what you've heard, follow our podcast and don't forget to leave us a review. It helps us to make it better and helps others to find the show. As always, if you want to join the conversation, find us on social media. Just search 11FS or Fintech Insider or email podcast@11fs.com. Thanks very much. Goodbye.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing Trust Center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Quora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.